We look at high yield investment to enhance the return of our portfolios, and we do it in a very well risk-adjusted manner. So what we want in high yield is high coupons, but also capital stability and attractive break-even. So the best way to do that is really to go at the top of the capital structure, because that's where you can get your first dollar back. The instrument we look at typically are leveraged loans issued by private equity companies or secured or unsecured bonds issued by very often ASX listed 200 or 300 companies. The reason we like that part of the capital structure is, as I said, we can have the first dollar back. There is a lot of protection, but we also think it's very exciting for retail investors for us to be investing there for them, because that's a part of the capital structure that has been reserved to banks or institutions, and people don't have a 10 million check to go for a loan or even a $500,000 check for bonds. So we think we can bring that to them, and it's good. There are good mitigants and risk mitigants into those instruments. I have a joke which is, high yield doesn't suffer mediocrity. The reason being you have only your capital and your interest back, but if you have losses, it's lost. So you need to do your homework very well, and we spend a lot of time analyzing company, understanding how they derive their cash flow, the sector they operate in, the challenges, but the advantage they have, how sustainable is the business, and therefore what is the critical value of this business, and especially the value backing where we sit in the capital structure. What we want is companies where we are very confident that even in a distressed scenario, we'll get our money back where we sit in the capital structure. That's what drives really our investment philosophy. We also are very lucky at Perpetual that we can get the help of our equity analysts sometimes, if they know the sector, the companies, or board members, etc. So we try to have that help as well. Finally, once we have done our work, and that includes also legal work that people may not be familiar with, but in loans, agreements are bespoken, so we need to look at that in detail. Once we are confident that we have good agreements and a good company, we can do a high conviction call, and that's when we go to portfolio manager and say to them, we think you should add that into your portfolio. So the high yield market in Australia that we really focus on, so the leveraged loans and high yield corporate bonds, we see that market size around 6 to 8 billion a year of issuance. People would be familiar with a lot of the names. So for instance, in the leveraged loan space, some companies are being privatized, so MyHub at the moment, Green Cross, and there are also a lot of companies like iMed Radiology, when people go for an IRM, Iron Mountains, who acquired Recall, has leveraged loans. So you have a number of large operators that people would be familiar, but they are just in private hands, so you can only privately invest in those. And in the corporate bond space, we have been looking at NextDC that people may be very familiar with, or companies like IMF Bentham, Centuria, etc. The way we look at high yield is actually to mitigate risk. So to achieve that, we look at the top of the capital structure, and that's where you'll get your first dollar back. So we look at senior secured loans or senior unsecured bonds issued by companies which are ASX listed. Therefore, we believe we have a good way of mitigating the risk, and we have very attractive risk-return parameters.